Welcome to the Academy. In our previous recording, Where Do Rates Come From, we were talking about how we derive various rates and, of course, how we can use those to assess our investment returns. In this episode, which we've broken down into two parts, I want to discuss how changes in those rates can affect bond prices. We're talking here of essentially interest rate risk, and when we use that term, we tend to think of something called duration. So in this episode, we're going to ask the question, what is duration? Let's just start off with the basics when we're thinking about bond risk. Imagine we had two practically identical bonds with a couple of exceptions. One of those exceptions is the coupon. So these bonds, as I say, practically the same, but one has a lower coupon than the other. And which would you suggest is going to be the riskier of those bonds? Well, logic would tell us it would be the one with the lowest coupon, because the coupon is the rate of return we're getting back on our investment. And if that rate of return is low, it effectively means that the investment lasts longer. Our money is at risk for longer. So we would suggest, once again, the low coupon bond, all things being equal, the one with the lower coupon would be the riskier. And again, keep with those same thoughts when we talk about the time to redemption. A short-dated bond versus a long-dated bond, with all other things being equal, we would suggest that the long-dated bond, again, is going to be logically the riskier. Your money is out there for a lot longer, and much more can happen to that bond, all things being equal. So they're the basics, but imagine if we had a situation where we had two, again, practically identical bonds, maybe both long-dated, but with very, very high coupons. Then we need to take things just a little bit further, and we go into this area of duration. Now, duration comes in many forms. The first one we're discussing here is called Macaulay duration, based on the work of Frederick Macaulay. And here we're looking at the effects of those coupons and the time to redemption on the sensitivity of that bond's price to a change in interest rates. Now, you can see the formula here for Macaulay duration, but I'm going to start off by taking things just a bit slower and going into hopefully a nice, simple, intuitive example. So we've got a 3-year fixed coupon bond. The coupon of the bond is 7% per annum. And of course, that 7% is based on the bond's nominal value or face value, which in this case is $100. This bond is paying annual coupons and it has a yield to maturity of 5% per annum. So we know what the future cash flows are going to be, all being well. At the end of the first year, we're going to get $7. End of the second year, $7. And at the end of the third year, we're going to get the final $7 plus our 100 nominal value. Using a yield to maturity of 5% gives us the following present values. The 667 in the first year, 635 second year, 92.43. And the bond's price is simply a sum of those present values. Now we need to discuss the risk on this bond in terms of Macaulay duration. So what I'm about to do is going to sound strange, but please just work with me for a few moments. The 3-year timeline. We've got our present values for our 3-year bond. We've just discussed those on the previous slide. I want you to imagine, again, it's going to sound strange, this 3-year timeline is now a plank of wood. It's a 3-year long plank of wood. And we're going back to kindergarten, to nursery school, where we played games like this. We'd take a plank of wood and we'd balance on that plank of wood all kinds of objects, toys, books. We'd take a piece of metal underneath called a fulcrum and move that fulcrum back and forward until we found perfect balance. So that's what we're going to do here. The present values I've now turned into weights. So there's a weight at T1, 6.67 kilos. There's a weight at T2, 6.35 kilos, and a very large weight at the end of the third year, 92.43 kilos. So all I've done is taken those present values, turned them into weights. Now, just by looking at that graphic, where would you imagine the fulcrum should go? Where would the balance point be on this situation? Well, I can tell you exactly where it's going to be. It's going to be 2.81 years along our 3-year long plank of wood. But where's that number coming from? We'll talk about what it means in a moment, but where does the number come from? Well, with that formula you saw on that first slide, you could see Part of that calculation was to time weight those present values. There's 1 year to the first cash flow, 2 years to the second cash flow, 3 years to the third cash flow. So we simply time weight those present values. If I take one lot of 667, it gives me, of course, 667. Two lots of the 635 give me 1270. And three lots of the 9243 give me 27729. And if I simply take the sum of those numbers, I come back with a new number of 29666. All I'll do with that is divide that by the sum of the unweighted cash flows, in other words, the bond's price. So I'm just going to take the 29666 and divide it by the 105.45. And this gives me a result of 2.81. 2.81, and I'm expressing that result in years. That's what we do with Macaulay duration. But what does it all mean? 2.81 years is effectively the balance point in this snapshot, because that's what it is. We've got to remember that your durations, Macaulay durations, any other durations, constantly in a state of flux, because of course our views are constantly changing. So just in this snapshot, I say once again, that's where the balance point would be given the information we have to hand, 2.81 years. Now, you can view this purely as a risk measure, in terms of if you had another bond that had a Macaulay duration of 4.81 years, that would be seen to be more riskier than this bond, just because of the higher number. But in terms of years, it's also useful if, for example, you're a fund manager and you have a liability to meet in a set period of time, let's say, for argument's sake, in 2.81 years. Well, you can use this bond or bonds with this Macaulay duration of 2.81 years to meet that liability, if everything holds true to what we're saying here. And this is your Macaulay duration. I'm talking about something called immunization. Now, we'll go into this further in other recordings, but the idea is when you hold bonds, often you have to worry about reinvestment risk. We're making assumptions here that the yield to maturity remains constant for the 3 years. And of course, that's typically not going to be the case. Rates are constantly moving, our views are constantly changing. But this is based, the whole pricing of this bond's based on the anticipation that when we get a coupon, we reinvest it at the same prevailing rate, which again isn't necessarily true. But using that kind of thought process and in using this Macaulay duration, what we can try to do is this thing called immunization. What we'll do is we'll marry up the Macaulay duration on this bond with the duration of our liability, and hopefully getting around this reinvestment risk. But how? How does that actually work? Well, let's look at the same bond example, but let's skip the numbers for a moment and just think of the process. So we've got our 3-year bond, 7% coupon, 100 nominal value. We've done all of that. The yield to maturity of 5%. And what we've just seen is our Macaulay duration of 2.81 years. The process. At the end of year 1, we're going to receive a coupon. That's the first coupon. What are we supposed to do with that? Well, we've got to reinvest it. We reinvest it at the prevailing rate for a time period. Now, if this coupon is coming in at the end of the first year, so T1, and we've got a liability that's in 2.81 years from T0, then effectively we're reinvesting it for 1.81 years. We're going to get a coupon at the end of the second year, and we reinvest that as well at the prevailing rate. In this example, it would be 0.81 years. So we're just going forward for 0.81 years. Now, what we are deducing from that is, of course, our future or terminal values. But they won't be enough to meet our liability that is falling, as we said, 2.81 years along this timeline. What we'll need to do is to sell the bond early. In this theoretical example, 0.19 years early. But how would we know the value of the bond 0.19 years before its redemption? You know that's easy. We simply take that last coupon and that nominal value, and we're going to discount it back at the prevailing rate over that time period. And this will give us our present value. And now we have the reinvested coupons and our present value, hopefully to pay for that liability, hopefully to meet that liability, all being well. But of course, it's making certain assumptions. And that's the problem. These measures are very, very well, but unfortunately, they do have limitations. We are assuming with this that when rates change, if rates change, they do so in a parallel fashion. We see a parallel shift in the yield curve. That means all yields move the same across the time period. And that's typically not always going to be the case. So that's one big assumption. We're ignoring credit risk. We're just going on the assumption we will get these cash flows. What happens if we don't? So that's ignored in those ways. So there's lots of limitations with these exercises, but of course, it's a starting point. It's something we can work with. So we're dealing with this thing called immunization, and hopefully if this works, great, we can cover the reinvestment risk. But we'll constantly have to think about changing our views, rebalancing, reweighting when we get further. But we'll talk about that at another stage. Now, this is okay, as we say, for attempting to do this thing called immunization. It's good if you have a set point in time and you're trying to aim for that set point in time to get these cash flows. But from a trading or investment perspective on its own, it's not really giving us what we started talking about in the beginning. And that was the risk of interest rate changes. This is useful, but perhaps we need to take it further into something called modified duration. Because your Macaulay duration will not actually predict the bond's sensitivity or reaction to interest rates changing. Okay, so what we do is we need to take it into something called modified duration. And we can use our Macaulay duration to come up with our result here. What we're looking at with modified duration, unlike our Macaulay duration expressed in years, is we're trying to come up with the approximate change in the bond's price for a 1% change in its yield to maturity. So this is going to be better, of course, to express that interest rate risk. So just to take the last example, to take that 3-year bond with its Macaulay duration of 2.81 years, as you can see from the previous slide, we're simply going to divide that by 1 plus the current yield. Current yield on this bond is 5%. That gives us a new number, and that new number is 2.68. Now, this is 2.68, which we express as a percentage, not years. This is what we call modified duration. So this is, once again, the approximate percentage change in the bond's price for a 1% change in its yield. So that gives us an idea. And remember, of course, the inverse relationship. If rates or yields go up, the bond's price comes down, and vice versa. So we can see it through this example of modified duration. But again, it has its limitations. We shall discuss those limitations and perhaps think about where we can take things further, but we'll do that in part 2. So I'll see you there.